themes currently driving the markets, and we will always discuss at the end some of the risk that we also see over the short and the medium term. So before we discuss the current environment, perhaps just a quick look back at what we mentioned to our investors as at the end of December. And a lot of discussions was focused on gold and the gold price, and we highlighted 4 potential events that can drive the gold price into 2026. And the one that's been the most dominant one so far this year has been the geopolitical risk, and especially the Trump administration and the events unfolding first off early in the year in Venezuela, then in Greenland, and then more recently, the conflict in the Middle East. Our outlook end of last year was actually for risk to de-escalate, and you can see how quickly that actually turned around. The other factor that we also highlighted was the central bank and their purchases of gold, which we think, depending on the price, the central banks will step in. But the events that unfolded in the first 3 months obviously caused a lot of disinvestment from retail investors, and you can see here the amount of gold being sold by retail investors who was basically buying gold on the back of a very strong rise in the gold price. So the gold price actually was quite volatile during the year, somewhat unconventional given the increase in risk in the markets. But it was the retail investors that actually disinvested as they perceived risk increased during the first quarter. Then on inflation, our view was that inflation probably will remain anchored between the 2.2 and 2.4% range. And that basically played out fairly stable into the first 3 months. And then what you can see towards the start of April, there was a massive increase in the inflation expectations of the markets. And this actually ties back to the uncertainty about when the conflict in the Middle East will be resolved, because the increase in energy prices has a direct effect on inflation. And then the final factor that we discussed potentially to drive the gold price is that the dollar probably will remain weak. And we were fairly correct on that call leading up until the conflict started. And you can see how the dollar, being a reserve currency and the safe haven status, actually started to appreciate again, and then actually started to come back as well. But on the dollar, you can see actually ended slightly lower, but there was this jump in the price of the dollar to other currencies as conflict increased in the Middle East. And the net impact, very briefly, if you look at the gold price, is starting the year around about 4,400. It actually increased by $1,000 quite quickly in January. And then you can see how retail investors starts disinvesting. You can see the price actually moved down back to the lows where it started. And you can see how volatile the price was. Where we ended up so far is around about $200 increase in the gold price, but it came with a lot of volatility. The other main theme that we discussed last year was obviously the AI and the technology around that. We focused on valuations and leverage, and just a very brief update where we're standing on that front. You can see, just looking at the price to earnings ratio as a measure of valuation, it actually came down. And then towards the end of March, we see a slight increase, but overall, the valuation levels slightly lower where we were at the start of the year. And if you look at the leverage, just looking at total debt to assets, not big movements so far. So currently fairly stable movements in the AI space. What we did witness, however, was a strong rotation out of the original CapEx spenders, the likes of Microsoft, Amazon, Google, Meta, into some of the semiconductor space. So we are seeing a shift to some of the other hardware providers in AI. And the reason why I would like to highlight what we've discussed last quarter is just to stress how quickly events can unfold that's unforeseen, which is making short-term forecasting extremely difficult. So let's discuss the themes that's currently driving the market. And the one theme that's still there is obviously the AI-led transformation. It remains the biggest driver of economic activity, especially through the CapEx spending. The market is also very excited about potential for productivity gains, and we are seeing still strong share price appreciation in some of the AI-related companies. Massive spending continues to build the infrastructure. So the data centers in the semiconductor space is still doing fairly well. And as I mentioned, the theme is starting to evolve. So we are seeing signs of impact on the economy, especially still CapEx driven. We are slightly concerned, though, that the prices has run ahead of actual earnings coming through. But the theme is still very much related that AI is potentially going to be a big driver of economic growth. Coupled with the AI rollout is, of course, the need for infrastructure, especially on the energy side. There's a massive demand for electricity, especially from the data centers. So we can see that a lot of companies in the utility space that's providing the services and the infrastructure for electricity, it's got potential upside. Coupled with that is also the conflict in the Middle East and the fact that many of the Asian countries, especially the likes of Japan, South Korea, and China, needs to diversify their energy mix. Relying heavily on oil has become a problem. So we are seeing that there's a stronger focus for alternative energy sources from these countries. And then the final theme is, of course, that geopolitical risk has increased. The conflict in the Middle East, Russia, the Ukraine conflict is also still playing out. So on the back of this uncertainty caused by geopolitical risk, we are seeing the world that's moving from a strong globalization to probably moving to deglobalization. Countries are focusing on supply chain security. In Europe, we're seeing a massive increase in defense budgets from these countries. And then being able to procure your own critical materials and technologies. So all of this is coming more and more important for countries, and this potentially could lead to higher inflation. So against these three broad themes that we see playing out in the market, let's just discuss then the short to medium term risks. The one biggest risk currently is that the market is actually pricing in a resolution to the conflict in the Middle East. And if you look at the graph that we're showing you on the left, the dark blue line is oil prices, the spot, so the current price. And the light blue line here is the price that you're paying for oil delivery in 12 months. So it's a 12-month forward oil price. And that you can see is still actually sitting at $80. And what this graph is telling us is that the market is currently saying the oil price in 12 months will be at $80. If the conflict lasts longer than what is being anticipated, this forward price will start to pick up. And that will place pressure on inflation. Inflation potentially will lead to interest rate increases, and that will hurt the consumer. So currently, if you just look at the graph now on the right-hand side, you can see crude oil spending as a percentage of GDP is still fairly low. It's not as high as it's been in the past. And the main reason for that is that the oil intensity, so basically the volume of oil consumed per unit of gross domestic product. So how much of your economic activity is dependent on oil, you can see is fairly low. So the potential impact of the higher oil price is not as big as it was in previous spikes of the price because countries are less dependent on oil as the only energy source. But this remains still a risk. For South Africa, I think we're all pretty familiar now with rising petrol prices. And it's not just on the petrol price side, but it's also a potential impact on our equity market. So this is an analysis from Goldman Sachs, basically showing you what the performance of our equity market is relative to the global market for every 10% increase in the oil price. And you can see South Africa, India, and China, we are reliant on importing our oil. So for every 10% increase in the oil price, our equity market potentially declines by 0.5%. So not just interest rates and inflation that's under pressure, but also our equity market. So the longer the conflict persists, the more pressure there will be on our equity market. Then just getting back to the US market. The red line we're showing on the graph here is the S&P 500. So that's a measure of the top 500 US companies that's listed on the stock exchanges. And then overlay on the graph is the US job openings. So essentially a measure of employment in the US. And you can see how these two lines actually follow one another. And intuitively, it makes sense. The US being a very large consumer-driven economy. So if the consumer is healthy in spending, the market will basically reflect that. But around about 2024, you can see there was a weakening in the US job market, but the equity market continued moving up. And we believe a lot of this is explained by the fact that CapEx spending by technology companies is supporting the market. So the underlying economy, especially the consumer, currently is under pressure. The equity market is being supported by CapEx spending. And the risk here is that at some point, CapEx spending might dry up and the reality might sink in that the consumer is not in a great state and that the red line potentially to decline. Then also on the AI theme, as we've mentioned, a lot of demand for energy is the fact that the supply currently is not keeping up with demand. If you look at the graph from the St. Louis Federal Reserve out of the US, it shows you the electricity per kilowatt hour for the US city, the average. And what I want to highlight here is this increase basically since around about 2021. And this is reflecting the need from data centers for electricity, and it's pushing up energy prices. This feeds into higher inflation, and it also takes basically your consumer needs to spend more on electricity and spending away from other products. Against this background, how are we positioned? I want to highlight two key positions in our portfolios. And remember, as I stressed quite early on in the presentation, making short-term investment decisions can be very risky, given how quickly the market plays out. But longer term, we think the need for energy independence is going to stay an important theme. And on the back of that, we are allocating to uranium as part of our commodity exposure. Currently in our commodity basket, we have gold, platinum, and silver, and we are adding uranium to that mix. As you can see, just looking out Currently, the supply of uranium is less than the demand. And if you look forward over the next 15 years, demand is going to continue to outstrip supply. And in such an environment, we see potentially share price appreciation of uranium. It makes a lot of sense for a cleaner energy source. You can see here there's already in Europe a big need to diversify. And in the US, interesting enough, is that they're running out of space in terms of energy generation. So nuclear footprint is much, much smaller than wind and solar because you need a lot of area to generate solar and wind. And then just on the other two main themes, the AI and infrastructure, I just want to highlight that we do have exposure to these up and coming themes in our portfolios. This exposure is predominantly from our active portfolio managers that we employ in our portfolio. So Bailey Gifford, a Scottish-based asset manager out in Edinburgh. I just want to highlight some of their holdings. You can see they've got exposure to SpaceX. ByteDance is essentially TikTok. And TikTok is using a lot of the AI to generate new content, or the users, you can see that. And then Anthropic is an AI company headquartered in San Francisco. It's basically well known for its program Claude, which is currently rolling out a lot of tools in the AI space. Our Goldman Sachs portfolio, you can see also exposure to the AI theme. Core Scientific operates data centers. Lumentum basically provides optical cables that is very much needed for the networks. And then Vertiv is another one that is a big player in the digital infrastructure. Their focus is very much on providing the cooling of these data centers. Global X by Maria Asset Management out of Asia is one of our value managers, and you'll see basically their allocations is much more focused on the infrastructure side, the energy side. So Diamondback Energy, basically oil and gas company in the US, the same for Devon Energy. And then CF Industries is a manufacturer of fertilizers. So you can see we're getting that exposure from our value manager. Then Research Affiliates out of the US, another value manager, also giving us exposure to the energy theme. So PBF Energy, also in the refining and logistics business of the energy side. Plug Power focuses on hydrogen, essentially. So a relative new player, but has done exceptionally well. And then Weatherford basically provides drilling, evaluation, and well construction. So more a services company that supports the oil industry. So we've got exposure to these up and coming technologies, and we gain that exposure through our active managers. And that is our update on the markets. Currently, as I mentioned, it's a lot of uncertainty, and a big part of the outlook depends on what plays out in the Middle East. We remain focused on being diversified. We think that's the best strategy for now, is to make sure that we are giving our portfolios sufficient exposure to different components and different strategies, and that diversification will provide us with sufficient exposure to the various parts of the markets. Thank you for your time. Until next time.